Hi, my name is Hilary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your August 2020 market update. The U.S. equity market experienced its best August in decades, with the S&P 500 index, a measure of the performance of the largest U.S. publicly traded companies, returning 7.19% for the month. Other areas of the equity market had robust returns as well, with domestic small cap stocks returning 5.63%, international developed stocks returning 5.14%, and emerging markets returning 2.21%. Commodities were also up on the month as the US dollar pushed to a two-year low, while fixed income finished the month of August mixed. The strong equity market performance put the S&P 500 at an all-time high, as shown by the advance above the yellow line on this chart. Despite high levels of unemployment, trends toward consumer spending and housing have been gaining momentum, and investor optimism toward the pace of the economic recovery continues to strengthen. So the index is now trading around 3550 and is looking a little bit overbought, shown where that yellow arrow is there. This points to the relative strength index of the S&P 500, which is around 80, and values above 70 can foreshadow pullbacks or at least a pause that refreshes. So given the recent run-up in equities and that we are heading into September, which tends to be a more difficult month for the stock market, as well as the upcoming election, we recently rebalanced portfolios in order to capture some of those nice gains that we experienced during the month of August. Now, one of the things to note about the rise in the stock market is that in describing the market's ascent, discussion has primarily been on the major indices such as the S&P 500. And investors may erroneously conclude that everything is back to normal. So while the S&P 500 is typically used to indicate not only the market's direction, this index has changed significantly over time, and these changes can easily distort the interpretations one can derive from its movement and levels. This chart shows a concentration of the top stocks within the index, such as Apple, Amazon, and Microsoft. And the top 5 holdings of the index now comprise 23% of the entire index. So we haven't been that concentrated in terms of just a few number of holdings since the early 1960s. Because the weightings of the top 5 or 10 stocks in the index have increased by so much, their influence on the S&P 500's performance has increased significantly as well. And the S&P 500 levels are really less representative of the US stock market now than they have been in the past because of that marked concentration that we're seeing in just a few names. If you take a look at the same 500 stocks in the S&P 500 and give them an equal weighting, meaning you give each of the 500 companies an equal voice as it relates to performance, what you can see on this chart is that the market is still in the recovery phase and has yet to reach all-time highs. So with all that being said, where are we year to date? Well, this is a periodic table of asset class returns, which shows by calendar year on the top, the best performing asset class, which is the asset class in the top box for each calendar year, and the worst performing asset class is shown at the bottom for each calendar year. And what this illustrates is that the best performing asset class one year is not necessarily the best performing asset class the next. And by having a globally asset allocated portfolio, which is what that gray box and the asset allocation box represents, investors get returns that are smooth over time, as well as experience lower overall risk. So year to date, while the S&P 500, which again is very concentrated in just a few names, while that is up about 10% year to date, a globally asset allocated balanced portfolio has had a return of about 2.1%, as shown here. And I would like to note that most of our balanced portfolios within LightPoint portfolios are well ahead of that 2.1% shown there. Now, one of the reasons why the stock market is performing so well in the midst of a recession is because the Federal Reserve has injected historical amounts of liquidity into the financial system. And additionally, in late August, the Federal Reserve made an announcement that it is updating how it is managing inflation. So the Fed manages inflation through interest rates, and if inflation increases above their target level, which is around 2%, they raise interest rates to keep inflation in check. So now that they've made this very large announcement during the month of August, the Fed is moving toward an approach of average inflation targeting, which will allow inflation to run moderately above target for some time. And so while that may not have been the market headline that captured your attention over the last few weeks of August, it definitely captured the attention of many professional investors because this has very large implications for the stock market in particular. So low interest rates, whenever interest rates are lower, what that does is that really provides cheap capital to both consumers and businesses. When interest rates are lower, consumers can spend more money and businesses have greater ability to finance operations, acquisitions, and expansions. So both of these are supportive of economic growth, which can lead to higher stock prices. Low interest rates also mean that the yield that investors can earn on bonds and cash is also low. And it's important to remember that when you're investing, there is always an opportunity cost involved. If you aren't willing to invest in stocks, where are you going to invest your money? So are investors going to park their money in a bank account instead? Well, here's a look at how much you can earn on cash as of the end of August of 2020. If you go to the far right hand side of this chart, if you have $100,000 invested in a savings account, typically right now you can earn $240 in interest per year. But just to keep up with inflation, you would need to earn $1,556. If you're saving for educational goals, just to keep up with education inflation, you need to earn $2,168 per year. And to keep up with medical inflation, you need to earn $5,024 per year. So if instead of investing in stocks, you want to invest in cash or even very short-term bonds instead, you are really guaranteeing a loss in real dollars. And so overall, the yield that you can earn on bonds or cash is extremely low by historical standards, making stocks more attractive than bonds. And because there is a much greater demand for stocks than bonds at this juncture, that is also very supportive of the stock market longer term. Now, the key word there is really longer term. Over the shorter term, you can always have some market pullbacks. And as stated earlier, the market is looking a little bit overbought. And in case you haven't noticed, we are approaching an election. And typically, market volatility increases prior to an election because the market does not like uncertainty. I thought this was a nice chart to show what market returns tend to be before and after elections. If you have a divided government, if you have a change in the composition by party, or if Democrats or Republicans take control. And this data goes back to 1948. And what you can see on this chart is regardless of whether the government is unified by party or split, stock market returns in the 12, 6, or 3-month periods prior to the presidential election do tend to be below average. Again, volatility tends to increase in the few weeks heading up to the election and even a few months ahead of time because there is a lot of uncertainty regarding potential policy implications and tax rates. But the main point of this chart is that although the months leading up to election can introduce a bit of volatility into the markets, the months shortly after the presidential elections have tended to have subpar returns, but the effect of the winning party and the extent of the win are inconsistent. When an election results in a continuation of divided government, returns in the first 3 months exceed those that occur when one party takes control. But 12 months after an election, this effect largely disappears. The inflation-adjusted returns of the S&P 500 are inconclusive when measuring election impacts. So while you may have very strong opinions regarding the upcoming election, don't let it influence what you do with your investment portfolio. You really should not make changes to your risk tolerance based on emotions concerning potential political outcomes because stock market performance is influenced by many different factors. Remember that we are investing for the long term, and market movements over the next 3 to 6 months will not derail your financial plan. However, making wholesale changes to your risk tolerance based on a very short-term market event that 6 to 12 months after it occurs has very little distinction in its overall impact can very well derail it. And we will continue to assess the market environment and we'll make changes to the portfolios as warranted. As always, please reach out to us with any questions that you may have.